Nick Elder with Ironton Capital, and I am joined here by my usual co-host here, Joe Massey with Synergy One Lending. How you doing, Joe?
I'm doing great, Nick. Great.
Quick note from our attorney here. So, guys, this is there's no fund or investment pitch here at all, but occasionally you might see some references to projections or returns as it relates to Ironton Capital's investments. Please note that this is not an investment or this is not an offering of an investment opportunity. Any investment, if you are wanting to discuss the opportunities with us that are available from a passive investment standpoint, I am more than happy to speak with you and schedule some time. And please note that any investment, regardless if it's with Ironton Capital or another firm, as you all know, does involve high, low degrees of risk. So definitely important to really understand your overall tolerance for risk. Again, you may see some forward-looking statements. Please note, all of those statements are just based on, projections that we have as far as our investments go. And then just a quick overview here of the investment team at Ironton Capital. We've got Lon Welsh. He's the founder. I'm sure a lot of you on this call know who Lon is. He started and sold the largest independent Colorado brokerage, Your Castle Real Estate. He then started Ironton Capital in 2022 as well. Prior to that, he spent about a decade in strategy consulting, working for some of the big accounting firms, and really been in commercial real estate for 2 or 3 decades now at this point. Also serves on the board of directors for Denver Zoo Boys and Girls Club, and Denver Ronald McDonald House. We've got Brent Geyer. He's our CEO. Has a almost as broad of an experience under his belt as Lon does. He spent held numerous executive level positions at various home building companies. Again, spent some time at KPMG where he specialized in mortgage banking. He's been in real estate for almost 3 decades as well, and has transacted on over 1 billion transactions in his career. And then Richard Landry, he's our chief investment officer. He's got Wall Street background. He's worked at Goldman Sachs. He's managed the investment portfolio and strategy for a multi-billion-dollar family office. He's held other executive level positions at firms similar to Ironton Capital as well. And he's responsible for all the investment research, procurement, and underwriting and financial modeling and investment selection at Ironton Capital. All right, Joe, tell us about consumer confidence.
It is low. We always start this slide. Years ago, this was our slide that we started with when consumer confidence was really high. And now look at that chart there on the left. You see that consumer confidence is at an all-time low, which is the same thing I said last month. Well, It's gotten a little bit worse. Gas prices are nearing record highs. There's a lot of uncertainty in the economic environment. Although we did get some positive news over the weekend, it looks like this conflict in Iran is going to be coming to a halt, which I think is going to improve a lot of things and help a lot of folks get off the fence. But if you're a real estate agent or you're talking with clients out there and you say, hey, it just kind of feels slow, this is why. Consumers are struggling to want to buy a washing machine, struggling to want to buy a car, and they're certainly struggling to want to buy a house because they're just not confident about where we're going and what's happening right now. So this is a big one that you're going to see. And a big part of that is AI and the fear of losing their jobs. This is a real fear that a lot of people have. And consumers are really pessimistic about the market. If you look on the left, is it a good time to sell? That's not a record low, but lower than we've seen over the last 5 years. And is it a good time to buy? This is one of the lowest readings we've had on record in the last 7 years that this chart covers. So a lot of people don't think it's a good time to buy. I disagree with that. If you were on our webinar last month, I actually bought a home the day after we did this webinar last month and got a smoking deal on it. I think it's a great time to buy. And Nick, let me ask you, do you think it's a good time to buy right now? Even with interest rates high, do you think it's a good time to buy?
I think so. I mean, for the exact reason you just mentioned, right? I mean, how many other buys were you competing with on a property that you absolutely loved, right?
Yeah. Yep.
I mean, we all know we should be contrarian investors, but when fear and uncertainty, and if we pay too much attention to the news, all that fear and doubt gets in the way, but ultimately, look at anybody that's made a ton of money in real estate, in the stock market. They've made all their money in times of distress when they were just simply aggressive when other people weren't. So, you have a lot less competition as a buyer. you have your pick at deals, and you have a lot of leverage on your side. As far as getting the deal that you want, the seller credits you want, and the price that you want. So take advantage of it. If you're in a liquid position right now and you want to buy real estate, I think now's a great time.
I completely agree. I have clients that are getting away with highway robbery right now on seller concessions, price reductions, inspection items. Lots of good deals are being had right now.
Yep.
So if you've got clients that are unsure, remind them you can get price reductions. You can get seller concessions. You can get the seller to buy down your interest rate. Lots of great opportunities out there right now. Unemployment, inflation, we covered that last time. It does appear that economic growth is slowing down as compared to second quarter and third quarter of last year. We're still up in fourth quarter of last year, up first quarter of this year, but it does appear to be just moderating. Doesn't seem like there's no breakout in either direction. There's no breakout that our economy is going gangbusters. There's no breakout that our economy is crashing. People are just kind of in a wait and see mode. We are seeing job growth slow down. That's leading to some pessimism that we may see increased interest rates, this going along with inflation. And a lot of people are worried about an upcoming recession. Nearly 2 out of 3 Americans think a recession is coming. However, most economists do not believe that a recession is coming. And we are seeing homeownership falling. The percentage of homeowners is traditionally pretty high. For folks that were born in the 80s and the 2000s, the age bracket from the 80s and 2000s, folks here in 2025, we're seeing a lot smaller percentage of people owning homes. In 1980, 75% of 40-year-old Americans own a home. Today, it's only 55%. That's a meaningful number, guys, of an age cohort or a demographic cohort that are still renting. Now, what does that mean for us? I know myself, I'm a landlord. Nick, you're a landlord. I would wager to guess that virtually everyone on this phone call is a landlord. If people are not buying homes, what are they doing? They're renting. So it can be good for us. If you're a real estate agent, you might not have as many transactions, but if you're a landlord or you're working with investors, might be a good time to buy. Fewer people are buying, more people are renting right now.
Yep.
And this, reiterates that point. That homeownership among adults from ages 25 to 34 fell for the second consecutive year to only 30%. Now, that means 46 million citizens are in that age cohort. That's about 4.5 million homes that have not sold yet, because those are folks that are sitting on the sidelines waiting for things to happen before they're going to buy a home. So might be a good time to buy. And then when all of those buyers come back into the market, what's that going to do to prices? Push them up. So that's one of the many reasons why I still think it's a really good time to buy right now. The average age of a first-time buyer is continuing to increase. This is really a function of it takes longer to save up a down payment, and it's a function of student loan debt, which I think we've got a slide for here in a little bit. There it is, student loan delinquencies. This orange line shows that student loan delinquencies are approaching 15%.
Wow.
If I'm behind on my student loans, I'm having trouble saving up for a down payment. Nick, am I likely to buy a home?
No, that's an alarming number.
Yeah.
I mean, 15%. I mean, clearly among the delinquency categories here, student loans takes the cake. Nobody's seems to be super delinquent on. I mean, credit cards is the second highest, of course, but student loans, you can't escape those. So,
yep, you can't bankrupt student loans. So if you've got student loan debt, having trouble saving up, likely you're going to be a renter for a while. Again, those of us on this call, that might be a good thing if we're buying investment properties. Increasing debts. This slide on the left, we really dove into this last time. We are seeing all-time record highs of mortgages, student loans, auto loans, credit cards, HELOCs. But does that mean there's going to be a foreclosure crisis? Just because we have increasing debt does not necessarily mean that there's going to be a foreclosure crisis. And we're going to talk about that in a few moments when we get to that slide. Right now, there are more sellers than buyers by a long shot. Sellers in the active market, roughly 2 million potential sellers, roughly 1.3 million potential buyers. This means that buyers can get really good deals right now. When there's more sellers than buyers, that means sellers have to make some concessions, have to lower their price, have to do something to get that home moved And this comes back to what we said earlier. I still think it's a really good time to buy because of this mismatch between buyers and sellers. Yep. And NAR, the National Association of Realtors, has reduced their estimates for market performance. They thought in November of 2025, they predicted that sales in 2026 would be up 14%. I would like for everyone as a homework assignment to go back and watch that webinar that we did that Lon and I both said, I think that is way too optimistic. And here we are 6 months later. NAR has revised their forecast that they think that home sales are going to be up only roughly 4% as compared to last year. And I think that's what Lon and I pontificated on back in November of last year.
Joe, we got a question. You say there are more sellers than buyers. Where does that data come from? I believe that chart prior. Yeah.
So it's hard to read here, but there's a firm called Arbor Research and Trading. And then they also get their information from Redfin via Data Arbor. They track the number of sellers that are out there, which that's pretty easy to do just based on, looking at the number of homes that are listed or coming soon. And then buyers, much easier to track, much more difficult to track, but they're looking at the number of signed buyer agency agreements. So folks that have engaged with a real estate agent and are actively looking for a home. So number of buyers that have engaged in a listing contract, number of sellers that have engaged in a listing contract, and number of buyers that have engaged in a buyer exclusive right to buy contract. So that's how they track that. And these folks at Arbor Data and Redfin are the ones that compile that data for us. So great question, Thomas. Now, who is buying? People move because of big life changes. So you might be saying, hey, I've got a 2.5% rate. I'm never moving. I'm sure my neighbor has a 2.5% rate. They're never moving. That's true. But what really causes folks to move? Having babies, getting older, a death of a spouse or a death of a loved one, getting married, divorces. All of these things are continuing to happen. Nick, I don't know about you, but I've helped a number of clients lately that are getting divorced. I've helped a number of clients that are downsizing. I've helped a number of clients that are having babies and their homes just aren't the right size anymore. So that 2.5% mortgage is a great thing, but life goes on and the home may no longer serve you, which requires that you sell it, renovate it, or keep it as a rental and buy something new. So that's what I'm seeing. I'm not seeing any elective trade-ups. What I mean by that is, hey, I've got a 2.5% mortgage and I want a bigger backyard. So I'm going to trade up $200,000 and get a 6.5% mortgage. I don't see a lot of that, but I do see, hey, my home, my starter home is 1 bedroom. I'm getting married. I need a 2-bedroom. I have a 2-bedroom. I'm having a kid. I need a 3-bedroom. Would you agree with that, Nick, that really what's driving transactions is just life changes right now?
Yeah, absolutely. I mean, we talked a couple of years ago about the lock-in effect, but we're now getting close to 5 years of being out of that lock-in effect where interest rates have gone from near zero at the Fed level to 3.75 to 4 today.
That's right.
And that happened right in the second half of 2022. So a lot happens in a year. A lot definitely happens in 3 to 4 years. So like you said, people are starting families in that time frame. They're getting married. In worst case scenario, they're having a divorce. But all of that are several catalysts for life changes that happen. From my perspective, it's interesting, Joe, because you see things from a different side than I do. Being at Ironton Capital, I see a lot of investors that have built up so much equity in their rental portfolio in Denver, and they don't want to be a landlord anymore because it's getting harder. Mm-hmm. Legislation's changing. It's becoming more in favor of the tenant. And they just want to capitalize on that equity that they've built up and reallocate that elsewhere. So all the folks I usually talk with, they're selling rental properties, or maybe they're selling a primary residence because maybe they turned 65 and they want to move somewhere else, maybe out into the mountains or what have you. So that's usually the type of investor I see who currently owns rental properties and is maybe undergoing some of these life-changing events.
Yeah, I think that's such a great point. I think you're spot on. Now, this again echoes that. What are the factors cited by recent buyers that prompted their move? Major life changes, a household member's health, new job, career change. I want a larger home. I love the one that's number 2. Nothing. prompted my move. There was no life-changing event. You know what? I actually fall into that category. If they would have sent me this survey, I bought a home a month ago, and what prompted it is I walked into an open house while I was out walking around the neighborhood. So I love that stat is sometimes there are elective purchases, but that's only 28% of the time. A large percent of the time, it is something else, downsizing, wanting a nicer home, something else. But I do love that nothing prompted it. Although, like I said, I'm in that category. Now, people buy homes for people, not for finances. And I love this. The primary reasons that people purchased a home, they wanted to be closer to family or friends. I wanted a larger home. I wanted a smaller home, change in my family situation, retirement, etc. All the way down here near the bottom, financial security is only 2%. So only 2% of the time do people buy a home. Now, I'm not talking about investment properties, but a home. They only do that for financial reasons only 2% of the time. Most of the time, it is family, bigger home, smaller home, retirement, having a child, whatever it might be. So I think while we're here and we're numbers guys, and the folks that are on this call, we're all number focused. The reality, most people buy homes because of what it provides them emotionally, not because of what it provides them financially. And I love this chart. I'm really happy that we found this one for this presentation. This one talks a little bit about seasonality. Right now, we're right in the middle of June, which is the best time for buyers to have the most choices, right? It's better for buyers April through November, and that is proving to be true this year. As we touched on early in this presentation, buyers are getting away with highway robbery right now. There's a lot of listings on the market, a lot of opportunity for price reductions, and this just really reiterates that seasonality that we see. And again, maximum concessions, better for buyers in July through January. So go over here. That's what we were just talking about. Homes that are going under contract right now in mid-June are starting to see a lot of concessions, and we're going to have that through the second half of the year. So if you've been thinking about buying, or you have clients that are thinking about buying, really a great time. Price cuts. Buyers in these markets can likely push harder for a good deal. In Denver, we're in the top 10 right there. Denver, Colorado, 15% of homes we're seeing 3 or more price reductions.
Wow.
I think that's a big number, and that moves the needle to get the home sold, but it moves the needle that there's opportunities for buyers. Do you agree with that, Nick?
Yeah, absolutely. I think that's why it's just so important. Maybe this is obvious, to really vet your comp analysis and make sure that you're pricing appropriately. Because if you do one price cut, you probably are going to do a second, then you might do a third. You just have the momentum going in the wrong direction. So as much as we want to be ambitious and think our home might be worth more, it's probably, we need to maybe dial it back and think, what is going to move this asset fast, rather than something that I'm going to sit on for 4 or 5, even 6 months because I priced it too high. So really make sure you're double checking your analysis on where you're going to price that property so you don't fall into this category.
100% agree.
Yeah.
All right, let's talk a little bit about inventory. Inventory in 17 states is higher now than it was pre-COVID, and those are generally the places with the worst price appreciation. We've highlighted Colorado because I think most of our guests today are here in Colorado. Inventory is 36% higher than it was in 2019. So 7 years ago, we all felt like, oh man, the market's going pretty good. There's not a lot of inventory. COVID inventory goes to like 15 minutes. And now we're back to a pretty normal market. We're pretty close to balanced when you look at inventory. And the softest, where we've had the most inventory build, of course, here in Colorado. And how do real estate downturns work? What you see, if you look at in the past, you see these peaks. Let's focus on 2008. You see a peak, and then you see a slowdown in prices, and then it always comes back. So we had this peak of prices here in 2022 after COVID, and then you see this real gradual decline there on the far right-hand side. We have not begun to regain. I think right now, and we talk about this, the last 2 or 3 webinars, I think we're pretty close to the bottom. If you would have come to this webinar in February when rates were back down below 6%, I thought we were going to see a big spike. We had some uncertainty in global affairs that have caused higher gas prices. And so I think we're just kind of riding it out, sort of right at the bottom of our cycle at this point. Do you agree with that, Nick?
Yeah, and I love this chart. As I'm looking at it, it reminds me of the importance of just a long-term thinking mindset when it comes to your investment strategy. If you're trying to do something, on a quarter by quarter basis, or even in a 5-year or under basis, you're especially susceptible to timing risk.
Right.
You look at just this. I mean, at the end of the day, this is covering what, 80 years and 60 years, excuse me. 59 years. 59 years. And at the end of the day, the trend is up and to the right. Now, of course, there's there's obviously some fluctuations year to year, but if you're looking at buying real estate today and you want to hold this thing for 20 years, the dips today or the highs of tomorrow are irrelevant, because in 20 years, you're going to have 20 years of debt pay down, price appreciation, tax benefits. So, ignore the day-to-day noise that is always all over the news. Always reference this chart. I think if you're a long-term thinker, this is the exact chart you want to look at and remind yourself of everything that I just highlighted. So I love this chart. This is great.
I love this chart as well. Did you know, Nick, that there is at no point in this chart that if you bought a property and held it for 10 years, you would have lost money? Even if you bought at the peak of 2008, or I guess it would have been late 2007, right before the peak. If you bought right then and you held it till 2017, you would have made money. There's never been a time that if you buy a property, hold it for 10 years, you'll lose money.
Exactly.
Over the market. Now, if you burn the house down or something, you might lose money. But according to, average appreciation, if you buy the home, keep it in good condition for 10 years, it will always appreciate.
Yep.
And then this is not the first time we've had a slowdown. Sales always come back, right? You go back to 1980, 2008, 2020, homes always come back. Now, right now, we've been in this recovery for a while, or I guess this downturn for a while. It's been almost 4 years. This is longer than we thought it would be. This is very similar to the early 1980s, which lots of corollaries to that. High inflation, right? Stagnation in the job market, uncertainty in the political environment, uncertainty in the global environment. We just sort of chug along. There's nothing that's going to break us out in one direction or the other. But I still think there's a lot of money to be made.
Yeah, and real estate cycles are much longer. I mean, it's not like the S&P 500 that's down in 1 year and then it soars back, and makes up for its losses the next year. It's a long cycle, which is really good because that means you have so much more time to make the decision to buy in those down periods. You don't have to make a decision in a week. You have maybe 2, 3, 4 years in this case, to act on that contrarian type investing and that kind of mindset. So, we're probably going to be in this for a little bit longer, I would imagine, but that's just more opportunity for everybody on this call to buy when others aren't.
I completely agree. Now, one thing everybody likes to talk about interest rates, right? Because I'm Joe, I'm the interest rate guy. I'm the devil because rates are 6.5%. But I think what we always forget about, taxes and insurance are up as well. The average monthly escrow cost has gone up 45% over the last 6 years, right? And then this map shows the average price of home insurance. And if you look at the eastern half of Colorado where we're at, home insurance is now on average greater than $4,000, right? Wow. So that's $350, $400 a month that people are spending, even if the property is paid off, right? Couple that with $300 or $400 a month in taxes, you're looking at $700, $800 a month, even if you have the loan paid off. So I think this is another stifling factor that we're experiencing right now. And I remember talking about this back in 19 and 20, that boy, insurance really seems to be going up. It's really going through the roof right now. And no signs of stopping anytime soon. Home affordability, we've spoken about this in the past. Let's keep going and talk about recessions. So Nick, I don't think we're going into a recession. I think you agree we're not going into recession. The majority of economists agree. But what if we're wrong? What if we do go into a recession? Does that mean that home prices are going to go down? I want to bring your attention to the chart on the left. 4 out of the last 6 recessions, home prices actually went up during the recession. Now let's add in 1991, where home prices went down very marginally, 1.9%. So we can say really 5 of the last 6 recessions, home prices went up or were flat. Now, what about 2008? You might say, well, that was a terrible recession. Home prices went down 20%. That's right. Home prices went down by 20%, but that's what caused the recession. So recessions do not cause home prices to go down. And that's one when Nick and I do these presentations and folks often chime in and say, yeah, Joe, you say it's a good time to buy, but what if there's a recession? Well, 5 out of the last 6 recessions, home prices went up or stayed flat, right? So I don't think it's a bad thing if I can buy the property now, hold on to it for the next 10 years, likely going to increase even if we do go into a recession. And then if we do go into a recession, what happens to interest rates? That's the chart on the right.
Yeah.
Rates generally go down when you exit the recession. So I can negotiate the price today, get seller concessions, buy the property with maybe a higher interest rate than I would like, but I can renegotiate the interest rate and refinance at a future date if we do have a recession. So exactly what Nick was saying earlier, contrarian thinking and thinking when everybody says don't buy, that might perk your ears up and say, well, maybe I should buy. And I think this chart really represents that. Will there be a foreclosure boom? Absolutely not. So I kind of actually, we might have to reorder this slide that this goes right after the debt balance.
Oh, yeah.
Homeowners are sitting on a record amount of equity. Even though mortgage balances are higher than they've ever been in the past, guess what? Real estate value and home equity is higher than it's ever been in the past. So the orange line is the value of real estate in the current market. The blue line in the middle, that is equity. And that green line is mortgage debt. Now, if you go back and you look at 2007, 8, 9, you see that home mortgage debt was higher than equity. So we were actually upside down as a nation. What does that lead to? Lots of foreclosures. Go all the way to the far right. We have more equity than we've ever had at any point in history. There's not going to be a foreclosure boom. Nick, if you had a $300,000 mortgage and your home started at $320,000 and is now up to $600,000 and you can't make the payments, are you just going to give that back to the bank and get rid of that $300,000 of equity?
Absolutely not. I'm going to sell it, or I'm going to call you and you're going to help me with a refinance. I'm going to pull that equity out and deploy it or use it for liquidity. So that's exactly why there's not going to be a foreclosure crisis, right? I mean, it's again, with the record amounts of equity, minimal home mortgage liability exposure, people can be flexible right now. Like you said, they can call you, Joe, pull out all that equity, or they can go sell the home, get all that equity out of the property. Now their problem solved. They're good.
Yep. I had a great technical conversation. That's me being facetious with an agent last week. She said, all of my buyers are just waiting for the foreclosure crisis. I said, okay, I get it. Do you think that there's a foreclosure crisis coming? She said, yeah, absolutely. I said, why do you think that? She said, there just has to be. There's no other answer. Do you have any data to support that? No, there just has to be. I just feel like there has to be a foreclosure crisis. Okay. I decided not to take out any charts and go down that road. But I just enjoyed that interaction, that the answer was there just has to be. If by and large consumers have massive equity and a way to sell their home, which they do, and not go into foreclosure, you're not going to see a foreclosure crisis. But I chose not to engage in that argument. I just accepted I think I have a different point of view. But I did enjoy that. And that's why we teach these classes. So you guys can actually have some good talking points and see there doesn't just have to be a foreclosure crisis looming on the horizon. Another important reminder, 40% of mortgages in the United States do not even have a mortgage. That means 40% of homes, there's no possibility that they could even go into foreclosure. And homeowner equity remains historically high. Look at Colorado. The average home has $332,000 in equity. Nationwide, the average homeowner has $295,000 in equity. If you're expecting a foreclosure crisis, you might take a look at Oklahoma, where they have an average of $14,000 in home equity. Maybe Iowa, $119,000. But any of these states in dark green, I would not bother. California, no way. Washington, Colorado, Utah, Wyoming, West Virginia, $100,000, $120,000 average equity. Maybe you could go there. The only problem with that is West Virginia. So I don't think I would want to invest in real estate there. Foreclosure volume. Now this is where people say there has to be a crisis, right? They look all the way at the bottom here and they say, Oh, foreclosures are up 5%. Foreclosures are up 7%. Okay, that's true compared to 2020, 21, 22, but we were off a surprisingly low base number, right? If you have 5 foreclosures and then the next year you have 10 foreclosures, foreclosures have doubled. Well, okay, but that's like saying if I drink 1 beer and then tomorrow I drink 2 beers, I've drank twice as much alcohol, but it's still only 2 beers, right? I think we need to remember that. Yes, foreclosures have gone up. They're up 10%, 20%, 30%, 50% in some markets. But several years ago, there was like 2 foreclosures. Now there's 10. That's not a meaningful number that's going to move the needle. A foreclosure crisis is this chart on the left when we had 900,000, a million foreclosures. That's a foreclosure crisis, not what we're looking at today.
Well, look at where we're at even compared to, I mean, let's distance ourselves from the financial crisis and housing crisis of 2008. I mean, let's go into the mid-teens here, 2015, 2016, 2017. We're still even at half the levels that we were then, when we have already been experiencing that road to recover, or road after recovery.
That's right.
And the market is doing really well. I mean, that's when, especially in Denver, the market was crushing it. We had 6% appreciation a year, and there was still double the amount of foreclosures in that time period than there is today. So that's a good point, Joe. Like we gotta zoom out. We gotta take a look at the 30, 40, 50 year view, and not just compare, well, what were foreclosures last year? Because maybe they are up 50% from last year to this year, but it's a meaningless number when you look at historical data, particularly around 2008, 2009, and all the way through 2020, really, before we saw that quick decline.
Yeah, absolutely. I think that's such a great point. I'm glad you brought that up. 16, 17, 18, we were all sitting around touting our 6% appreciation, happy as we could be. And nobody ever even brought a peep up about foreclosures. And what do you know? Foreclosures are half of that. Yeah. And that was a great market. So if you think foreclosures are going to go up, or if you have buyers, I would encourage you to share these slides with them. Have them call me. Let's keep going. Mortgage rates, my favorite question. Mortgage rates rise with uncertainty, and they usually fall back after the uncertainty has resolved. That has occurred 14 out of the last 17 times. So the uncertainty we're referring to right now is Iran, and that's going to be way over here on the far. Actually, it's not on this chart. This is historical times that this has happened. We've seen interest rates increase almost 0.75% since the original conflict in Iran began back in late February. Do I expect rates to get better? Yes, I do. Do I think it's going to happen overnight? No, I don't. I think it's probably going to be a slow slog to get back to 6.4, 6.3% interest rates. And I think we've got a slide projecting what's going to happen here somewhere. Here we go. Rates currently stand at their lowest level in the last 3 home buying seasons, right? So right now we're right at 6.5% on the far right hand of the chart. Last spring, 6.7. The spring before that, 7.2%. So back to what we were talking about earlier, I think it's a good time to buy. You can get away with highway robbery on concessions, price reductions. Yeah, I got to have a 6.5% rate, but you know what? It's not the 6.7 from last year. It's not the 7.2 from 2 years ago. And I think we can all agree we're right kind of at the bottom of that cycle where home prices will begin to pick up, especially as we get past the geopolitical uncertainty that we're experiencing right now. Do you agree with that, Nick?
I do. That last chart was that you had was really interesting. It's if the U.S. can just stay out of war and conflict overseas, then we might just have better interest rates. It seems to be that's a common trend. So, I agree. I mean, if we want to go back, it's also really encouraging to see where we were 2 years ago. It's almost 7.25 to today, 6.5. So interest rates have come down, over the last 2 years. It still feels very high, but we have made a lot of progress just in the last couple of years. So I think it's going to be another, probably a couple of years till maybe we get within reason. But, that's, again, like I said before, it's more opportunity for the people on this call who want to invest and want to deploy capital to take advantage of this time period. Yeah,
I completely agree. We're also seeing that rates are continuing to improve, and the spread between the 10-year Treasury and 30-year mortgage rates, this is what's called a risk premium, is getting a lot better. That's helping us see better interest rates, which I'm happy to see. And change in the 10-year yield after wars begin. You see that the yield goes up pretty significantly after wars. And then, as we touched on a few slides previously, they'll get better once that Iran conflict has been resolved. The lock-in effect, we touched on this. The lock-in effect is really beginning to ease. And I bring your attention to the dark blue line at the very top, and then maybe the dark black line just below that. We have a lot of people that we know, that Nick knows, that I know. They say, hey, I've got a 3% mortgage rate. I'm never moving. I have a 2% mortgage rate. I'm never moving. Nick, have you ever heard somebody say that?
I have. Yeah. I hear it less now, but
yeah,
it's said.
If that were true, this blue line and this black line would be perfectly flat, right? But the fact of the matter is life happens. I actually helped a gentleman refinance just last week. He has a 2.5% rate on his first mortgage. We refinanced and his new loan is at 6.25%. Now, why in the world would he go from a 2.5% to 6.25%? He took $250,000 cash out to consolidate credit card debt, to renovate the home, to pay off a vehicle, and to fund some alternative investments. So I think it's important to remember, just because you have a 2.5% rate, you've got to look at all of your financial picture. And this gentleman was paying 29% on more than $100,000 of credit card debt. So his blended rate between his 2.5% mortgage and his 29% credit card debt, his blended rate was like 15. So we gave him $200,000 or more than $200,000 cash out, and he actually saved money on a monthly basis, right? So the lock-in effect, while psychologically is a real thing, it is beginning to ease because life goes on.
Well, you know, Joe, that same person in 2008 would have probably had to foreclose on his home, and he would have had to sell at a massive discount and lose money on the home, plus owe all that money in credit card interest. Now, because of all the equity he's built up, he was able to get out of his probably pretty painful situation simply by doing a refinance. So I think that just further validates a lot of the data that we were talking about, 20 minutes ago.
Yep, that's exactly right. We do have one slide here on interest rate projections. I'm not quite as optimistic as Fannie Mae, the Mortgage Bankers Association, and Wells Fargo. They all predict that we're going to be somewhere around 6.1, 6.2 by the end of the year. If there was a Joe Massey line on here, I think we're going to be right around 6.4, 6.3% by the end of the year.
Yeah.
But overall, this is still very positive as compared to where we've been the last couple of years, and historically very attractive. This slide's a little bit outdated. Current interest rates right around 6.5%, but we're still well below the 50-year average of 7.7%. So as we're wrapping up here, guys, any other questions, please type them in the chat. And Nick, if we want to get more information about you and Ironton Capital, how would we reach out to you?
Yeah, you can go to, well, first and foremost, if you just want to learn more about passive investing, maybe you're an active landlord now, and you're evaluating some options to maybe redeploy capital, or you're considering selling your rental properties. If you're really at the beginning of the education stage and wanting to understand what else is out there for you to invest in, you can go to this irontoncapital.com/guide link. We've got about a 70, 80 page book that, really tells you a little bit about Ironton, but mostly about what does passive investing look like for you as an investor. So great educational manual there. You can go to that link and download the book for free. You can go to Amazon, buy a physical book, or we'll send you a physical book as well, if you like. And then if you want to go to the previous slide, if you are wanting to do an analysis, for example, a lot of investors, they come to us and say, hey, look, I've owned this property for 10, 15, 20 years. I don't know what to do with it. I know I want to sell it, but I don't know what my next options are. I need to figure out what I'm going to owe in taxes. And I want to at least find out if there's better ways to deploy this money than it's sitting in a very low leverage rental property that's maybe making 4 or 5% return on equity. What should I do? And so the next step really is we'll run an analysis on your rental property. We'll present to you the business case. If it makes sense, it makes sense. But really the important thing here is that you can go to this link. We'll run that analysis for you, and you'll get, the dry numbers of what selling that property might look like. And then Joe also does analyses on if you want to do a refinance or get a HELOC. So I know he does a lot of those as well. So point being, guys, we're here as a resource. First and foremost, we want to educate, talk with you guys through your situation.